Anyway, all right, well, I'll kick things off then. So, thank you so much to everyone who has shown up today. This has been a topic that has been near and dear to most agents' hearts. So, on behalf of the Profitability Committee, we are very happy to invite Henry Michaud to speak to us today about incorporation. It is a hot topic. It's definitely something that we're all kind of trepidatious about, eager about, there's all kinds of perceptions around it. Henry's going to break this down and help us understand the pros and cons and whether or not it's going to make sense for our individual businesses. And from what I can tell, it is a very individual decision. So, Henry, I'm going to pass this over to you. And thank you so much again for doing this.
Okay, Sherry, thanks. Yeah, to incorporate or not, that's the question. Um, Goofy little starting point. Um, uh, as Sherry mentioned, my name is Henry Michaud. I'm a CPA CA, CA old designation. I've been a partner with Wild Timmins Michaud since 2006, basically when I moved here from Alberta. And I've worked with Jerry and Annette probably since 2006 in various different ways, and with Keller Williams since they've started the company. Um, so let's just jump right in. Should I incorporate? 10 years ago? Simple question, simple answer. Yes, right off the bat. It was really easy. They've recently had, and I'll say recently, 7 years ago, had tax changes that made the answer a lot more complicated. And so now we have to look at what the pros and cons are. Um, and so basically, I've broken these down into two pros and two cons. The cons really, in my mind, is just one, is just cost. Complexity is a bit there too. The two main benefits is limited liability. That may not be such a big one for the agents. And then it's whether or not there's a tax advantage. Okay. So limited liability, the corporation is considered a separate entity. Okay. And so if somebody was to sue the corporation, they can only go after the assets of the corporation. They sue you as an individual, they can go after all your personal assets. So the idea is that if you have a limited amount of assets in the corporation, that there's a limited amount that an individual can go after if they're suing the corporation. So that's why we talk about limited liability. Okay. Again, that's only a concern if people are able to sue you for some reason. Okay. I'm going to go over some tax advantages. Two main tax advantages is lower tax rates in a corporation and what we call tax deferral. And I'll go over these in a little bit more detail. I mentioned earlier, if you have any questions, don't hesitate to ask at any time. And if you want to post it in the chat, by all means, do that. I have it. You may see I'm swiveling. I got three screens, so I'm kind of swiveling between the three to try to capture everything. Okay, so lower tax rates. Personal tax rates start at 25% and they go up to 54%. As you know, we have a graduated tax rate system for individuals. So depending on what your income is, you're taxed at different rates, and it moves up through those income rates. The corporate tax rate here in Nova Scotia is moving down to 10.5%. They just announced this in the latest budget in March. So by March of 2026, the tax rate will be down to 10.5%. It's prorated over the year. Okay. The Canadian tax system is based on a concept called integration. This means that you should be, and I say should be indifferent between earning the income personally versus earning the income through a corporation and then taking that money out of the corporation. Okay, because there's two components when you're incorporated. You both have the corporate tax, and then when you take the money out, you're paying personal tax on that money when you take it out, usually in the form of a dividend. Okay, so you should be indifferent between those two. Okay, we're going to go over an example. So let's say in the two scenarios, you both earn $50,000. This is after your expenses. In a self-employed situation, you would pay personal taxes pretty close to $8,000 on that. Plus, you'd have to remit CPP on that earnings of about 5,500. Okay. This means that at the end of paying those two amounts, you would have in your pocket about $36,000. Now, in a corporate situation, if you earn 50,000 in the corporation, first you have to pay the corporate taxes. So you have just a little over 5,000 of corporate taxes on that amount. Then we were going to say that you pay the rest of the amount out as a dividend to the individual. Okay. So we're going to pay a dividend of 44,750. You're going to pay about $4,500 in personal taxes on that dividend. Okay. This means that in your pocket at the end, you have 40,000. Now, as you can see, we already have a bit of a disconnect between the self-employed and the corporate. And in my mind, this mainly revolves around the fact that you have to pay into CPP on the personal side. Okay. It's kind of like a forced retirement planning uh, on your self-employed earnings. Now, my research on CPP is that it's not a very good rate of return. So it's not a good way to plan for retirement. The rate of return, from what I can tell, because you're paying in both halves, you're paying in as the employee and the employer, the rate of return on that investment is about 1%. So you can find other investments that do way better than that. But it is forced, and so it is something that you would have. If you don't plan for your own retirement when you're incorporated, if you have nothing left at the end, you have nothing left at the end. At least putting something into CPP means you have a little bit of income when you retire. So it's something. I don't think it's a great thing. Not to make up the, pretty close to $4,000 difference that we have in this example. When I did this years ago, the difference was quite different, and I suspect the difference I had was about $1,000 between the two. I suspect that the main difference is the CPP. I mean, yeah, the tax rates in the two change over time. Corporate tax has gone down a bit since I last checked it. But the CPP, they've increased the rates, they've increased the maximums, so you're paying more into CPP now than you did even just a few years ago. So I suspect that's where the major change is happening. Okay, so that's the tax advantage. Okay, tax deferral. This is where we talk about the time value of money. So a dollar today is worth more than a dollar in the future. So what does this mean in this setting? Well, in a corporation, if you don't take the money out, you're not taxed on it personally. So by leaving the money in the company, you're deferring the personal taxes to some future date. So there's a tax savings to be had by that. Now, you can accomplish basically the same thing by making an RSP contribution when you're self-employed. And so I'm going to show you an example of that. Okay. Back to our same example of 50,000. Now what we're going to do is we're going to say under the self-employed, we put 20,000 of that aside into an RSP. It's a pretty hefty amount. Just for our example. So now the income personally is 30,000. The personal taxes is actually really low. in this case. I was kind of shocked when I first did this. I'm going, how can it be that low? I'll get to that in a second. Again, the CPP is still the same, is basically the same, still 5,500. So now we only have 20, just a little under 24,000 in your pocket, but you have the money in your investment, in your RSP. Okay. We look over to the corporate. We left 20,000 in the company. Okay, so now we only took 24,750 out of the company. The personal tax on that is 1,000. Okay, so we're left with very much the same amount of cash in our pocket after we left the money in the corporation, and we still have that cash invested, but it's in the corporation. Okay, so that's a slight difference. Okay, so things to consider on the self-employed side and a little bit on the corporate side too. Um, do we actually have the RSP room? Um, 50,000 of income only generates 9,000 RSP room the next year. It's only 18% of what you earn. The previous year creates room. So you're not going to be able to do this every year. You're going to you're going to quickly run out of RSP contribution room. You may have built some up to this point, but you're going to slowly run out of room and you're only going to be able to contribute the minimum so that you're going to run into a situation where you're not able to put as much aside as you possibly would like and defer tax on that amount. Uh, the reason why the personal tax was so low in the self-employed side is that it was actually running into, because the income was low enough, it was running into a Canadian working benefit of $1,600. This is a calculation that's based on family income, so it may not actually be a tax savings that's available to you. I just left it in there because my example was an individual earning 50,000, so I kind of left it pure with that. Um, the benefit disappears when the family's income is over about 38,000, so it wasn't too much higher than where we were already. So if you have a spouse and she's making her own income, you're not going to have that available to you. So we now have a difference of 1,600 between the two examples. One thing I wanted to bring up was that when you invest in your RSP, of course, you don't pay tax on any of the earnings inside of that until you actually pull it out. So it's a true deferral. You don't pay any tax on that money until you pull it out, hopefully in retirement when your tax rates are low. In a corporate setting, it's a little different. When you have investments in a corporation, whatever it earns in the year, it's going to be taxed on that earnings in that year. So you got to take that in consideration. It's going to skew it a bit. There's additional taxes to be considered in the corporate setting with investments. And it also kind of runs counter to that limited liability concept that we had at the beginning. You have investments in this corporation, now they're available to somebody that's suing you. So if that's your plan, there's once you start building up those investments, you got to do further planning. It makes things even more complicated. So I just wanted to bring that up as an issue with this idea. I'm running through this a lot faster than I thought I was going to. Okay. Um, so the cons, higher costs. Okay. Number one, there's the cost to incorporate. Um, my recent discussion with a lawyer, it's still around 1,500 for them to incorporate. This can be more, um, and can be a little bit more complex if you've got an existing business. Uh, I don't really want to go into it too much. There's some tax rules that you may have to navigate if you have an existing business. Um, I'm not sure if they're really all too relevant with respect to an agent. It's more, the issue really revolves around whether or not your business has goodwill, meaning that your business is something you can sell. And if if that's the case, then it's a lot more complex to incorporate because you don't want to trigger a tax event to take your personal business and incorporate it. And so there's some legal maneuvering that needs to be done at that point. So it would cost more to incorporate in that case. Your accounting costs are going to go up. Most people may feel comfortable doing their own tax returns, even if they're self-employed. Um, but very few, if any, would feel comfortable doing a corporate tax return. So then you're getting somebody like me to help you out with your corporate taxes. Now, if I was to do an individual's self-employed business taxes versus that same person if they were incorporated, I would think the difference would be about $500 a year that I would charge more for doing the corporate work than doing the personal tax work, just to kind of give you an idea of the difference in accounting costs. That difference is really relating to the fact that we do more work in the corporation, specifically with respect to the balance sheet. And I don't know if you know too much about uh, financials and that kind of stuff. The personal taxes really revolve mainly around just the income statement of your business. So that's your revenues and your expenses. Corporate taxes also need to divulge the balance sheet of the corporation. Okay, so that's your assets and liabilities. And this is where accountants really focus a lot of their work. We focus a lot of work on making sure the assets and the liabilities of a corporation are accurate in reporting the corporate taxes. So that's why there's a little bit more cost involved with doing the corporate taxes with respect instead of the individual taxes.
And can you just
Another
explain a
small
little,
cost.
sorry, can
Sorry.
you just explain a little bit more about assets and liabilities, and how they differ
Sure.
from when you're doing your personal taxes, just to help people get a context for corporate?
Yeah, yeah. So assets, your bank account's an asset. So and then if you also start investing in the corporation, that would be an asset. Other assets that could be in a corporation with respect to an agent could be a car. And we would amortize that, write it off over time. And so there's how we do that in that we would deal with in a corporate setting. Uh, Other ones could possibly be receivables. So let's say you had a sale right near the end, but you weren't paid for it until the next month. That would be a receivable. You also have payables. So let's say you have a Visa card that you owe money on that covers expenses that you're paying for with respect to your business. That credit card is a liability. You have to pay it off, and so we have to track that amount. You may owe an amount to Keller Williams for costs that it covered. And so that would be a liability, also a payable. Uh, your corporate taxes is, of course, a liability. You may be registered for HST and you might owe an amount on HST. So that's a liability that we would have to track. You may have a loan with respect to the car that you own in the company, and so that has to be tracked, and we have to determine the interest on that and write that off. So there's a bunch of different things that we could possibly be looking at with respect to a corporation. We also track on what you personally may or may not owe that company as the shareholder. In a lot of cases, you may be paying for things um, yourself personally on behalf of the company, and so the company owes you that amount back. So we would have to track how much the company owes you back. You may have accidentally taken too much out of the company and you owe the company back some money. We would have to track that too. So there's a bunch of things that we kind of look at. And as you can see by the list I just gave you off the top of my head, it can be quite complex.
So it also kind of sounds, Henry, like if you're someone who is considering incorporation, then some of those key basics are really important. So making sure that all your business endeavors are happening through either like a separate account, making sure you have separate credit cards, making sure everything is absolutely 100% separate from anything that you do personally. Would that be
Yeah.
accurate?
Yeah, that's definitely true. I've had some that it isn't, and it really makes it complicated because and to be honest, it's not like I really if I'm dealing with a corporation and their credit card, it's not like I really want to see all your personal spending when I'm dealing with just the corporation. Uh, you would want to keep that separate, so it's not a bad idea to have uh, separate cards. The credit card situation, it doesn't mean that the credit card actually has to be issued to the corporation. I have a credit card that is in my personal name, but I only use that credit card for my corporate spending. I have a different credit card that I use for my personal spending. So I just know when I'm pulling one out, and they're completely different. One's a Visa, one's a MasterCard, one's from Scotiabank, the other one's Bank of Montreal. So they're completely different. I know when I'm pulling it out, what I'm using it for. And so it just makes it a little cleaner that way. Um, when you get into larger companies, of course, the credit cards would just be issued to the company. That's fine. But at CRA has no issue if that credit card's in my personal name. I'm the shareholder of the company. I'm the face of the company. They would have no problem with that being run as a corporate card. Okay, what's your opinion? I'm just sorry. I'm just reading in the chat. GCI. GCI. I'm not sure
Gross
what that.
commission income. So gross commission
Gross
income.
Oh,
commission
okay.
income.
Um, Good question. I don't know if there's really a minimum. Um, on the personal side, you have your basic personal exemption, which is federally around 16,000. So you'd pay no personal tax on that. You're still paying CPP on that amount because CPP only starts at the minimum amount that you're not paying any CPP on is only like $3,500. So you'd pay CPP on that amount personally, but you wouldn't pay any uh, federal or personal tax or provincial tax. Provincial tax is a little lower, but um, when I ran, I used to have a really old um, chart that actually went from $0 right up to like 500,000. And the difference was actually pretty much the same all the way up the scale um, between corporate and personal taxes between the two. Um, it's actually quite a complicated uh, chart to do. I've been trying to reproduce one, but it's a little harder than I initially anticipated. There's things going on the personal side, especially the provincial side, where there's a credit for low income that kind of skews it a bit. But um, I don't have a specific figure for what that would be.
Would you say
Uh,
minimum 6 digits?
Sorry, what was that?
Would you say it's a minimum 6 digits before you'd want to do that?
Oh no. I mean, I use 50,000. I mean, you're saving 4,000 on 50,000 of net.
Okay.
So that's pretty low. Uh, the more you can defer, so the more you can leave in the company, I think definitely the more this it becomes attractive. But then you're also talking about probably a lot more complicated structure than just a simple corporation because you want those investments to be somewhere else than in the company that you're actively involved in. Um, but the more you defer the tax, because you're not going to be able to, if you're making 6 digits, presumably a good chunk of that you're not going to need to live on. And you're not going to have the RSP room to put that much aside every year. So now we're leaving a lot more in the company. And so it becomes a lot more attractive in that case. Um, Initially, investing in a corporation doesn't really run you into a lot of trouble until you get to having an investment portfolio of about $1 million. And then it starts causing you some issues. So initially, it's not too much of a problem. But I mean, if you're an agent that's continually making six figures, um, yeah, you can get there pretty quick. Um, I would think incorporating would still make a lot of sense at lower numbers. I've seen people that are incorporated that are only making 30,000. Now, probably when they incorporated, they were thinking they were going to make a lot more than that, but it still works at even those lower numbers. Um, so that's where it really makes it a hard decision. It's really a personal decision at that point. If you're making lower, does the added cost that you're incurring every year outweigh the tax costs? Because you might be getting pretty close to where it's break even. Um, I'm not sure where that break even point is. I haven't done that calculation. How
And
can
Henry,
incorporate?
in the past, when we've had agents ask that question, it's very much situational on the agent's own individual, personal financial situation. And to Henry's point, it very much depends on how much you're going to keep in the corp and how much you're going to take out of the corp. If you're draining the entire corp and you can't leave any money in the corp, you need that money to live on, it may not make sense for you to incorporate. So it's very difficult for Henry to give us a specific amount because it's going to differ based on your own personal financial situation. And that's where you need to get your own individual advice from an accountant on what makes the most sense for you.
Yeah. I mean, even in the example that I gave, the 50,000, this is net of your expenses. So presumably you would have earned like 80,000 and had 30,000 in expenses against that, just as a rough estimate. This was draining all the money out of the corporation. We were still ahead, almost $4,000. So even when you're draining the company, it still does work a bit. But this is just based on current tax situations. I mean, the federal government or even the provincial government could come out with their next budget and completely hose us corporately with a decision they make, and we could be that those numbers could flip. And that's just something that you would have to live with in the corporate setting if once you've decided to do that.
So
But I
this
just
is
wanted to quickly go back to that to show that there was still, even when you're draining the whole amount, there seems to be a bit of a tax advantage.
so this is fantastic we're doing this because I know I've always kind of the word, I guess the rule was if you make over 100K, you should consider incorporating your business. But then on another hand, and this is great information to know, but as a realtor, I believe that if you're going to create a team and you hire a licensed assistant or something, someone else, a licensed employee, then you actually need to incorporate. So maybe that's why someone at 30K might choose to do that. So it's a little bit different in our business as well.
Yeah, and here's the thing. You're going to have the same, and this might go into the second comment that Darcy made. You're going to have the same deductions on your personal taxes against your income as you will in the corporate setting. So if you have an employee, you can have an employee against your personal income. As a self-employed business, you can have employees. Um, you you can have quite a large self-employed business. You could technically have a business as large as, a public company as a self-employed business if you wanted to. There's no limit there. It just means that you're taking all the income that's being generated and paying tax on it right now. There's the only deferral you have is really when you're self-employed, the main deferral you have is that RSP contribution. Yeah, there's a few other things that you could run into, like if you make contributions to, or you make donations, yeah, that reduces your taxes a bit. Um, but that's only if that interests you. I mean, when you make a contribution, yeah, it reduces your taxes, but that money isn't yours anymore. So really, it's more, is the donation something that really hits you in the heart as something you want to do? That's why you're doing it, not for the tax relief that you're getting for making the donation. Okay, so uh, donations are one thing that are better personally than corporately. A donation in the corporation will only save you that 10.5% tax rate. A donation personally could very quickly, because the first 200 is at the low rate, but any donation over 200 actually saves you at the very highest tax rate. So you can actually save a lot more taxes with a donation made personally than one made corporately. Just as an aside to our discussion here. Yeah, so cars are dealt with a little differently inside a corporation versus on your personal tax return. But basically, the deduction would be pretty similar. Um, Corporately, you can pay yourself for using your personal car, or the car can be in the corporation, of which then the company pays for all the expenses. Makes it kind of easy that way. And in your case, as an agent, I would say you'd be using the car more than enough to justify it being inside the company. Personal tax is a little bit more complicated. Technically, you're supposed to keep track of your mileage, and it's only your business mileage over your total mileage. Uh, that ratio is times by all your actual expenses, and that's the deduction you get on your personal tax return. It's not that way in the corporate. If you've made this decision to put the car in the company, it deducts everything. Now, you can run into a shareholder benefit if you're using that corporate asset, that car, for personal use. So that gets into a complexity. To be honest, we don't do that calculation for any of our clients. We basically say, hey, let CRA try to figure that out. I only try to advise clients whether or not I think it's smart for them to actually put the car in the company in the first place. And usually I'm a little conservative on that. I would suggest I would only put the car in the company if you're using it at least 90% or more for business purposes. If you're below that, then you're really running into a lot of issues, potentially with CRA down the road if they were to look at it. And they have looked at vehicles in companies quite a bit recently. I've probably gone through at least 6, if not more, audits with respect to vehicles in a company in the last 2 to 3 years. So they're really looking at that aspect of corporations. Buying a house doesn't help you whatsoever. You can deduct a home office, both on your personal, and you can get a credit for a home office in your corporation. So that deduction would be basically about the same. Depreciable assets. The main one would probably be your car. I mean, you could have a computer. We can write that off in the company. We can write that off on your personal. Again, basically, it would be the same write-off. Okay. Uh, if you're incorporated in hopes to earn more over time, if that doesn't happen, can one then not be incorporated? That's a tough thing to do. Once you're incorporated, it's definitely a little harder to, well, maybe not so much. I would basically say if you wanted to unincorporate, you would just say, okay, I would go to Keller Williams, I'd go to Melissa and say, hey, I want to earn this income personally. Instead of having my corporation be the one that you're paying the commissions to, I want the commissions to be paid to me personally for this year and going forward. And that way, your corporation basically just dies with no more earnings. Now, if it has a bunch of
Is
money in there, that's a lot more difficult to get out without paying a lot of tax. So there could be some planning on that part of it. But I mean, if you're draining that company every year because you weren't making as much as you were hoping for, and there's really nothing left in the company, I would say that that's as simple as you could get. You could probably just go to Melissa and say, okay, I'm changing this. I'm not going to have the commissions earned in my company anymore.
So I just need to jump in there. It's not quite that simple because with our regulator, the Nova Scotia Real Estate Commission, your approved sales corporation is a separate license. So first of all, if you are not incorporated and you're thinking of incorporating, you need to get your name approved first. Don't spend all the money incorporating your name for your corp without checking with Anne or myself first. The NSREC is very, very strict on what they will allow for a corporate name for a real estate agent. It's basically Melissa Geddes Limited. That's it. They won't allow any other name. So if you've got a corp that you're already looking to um, continue using and flip it over to your real estate business, we've run into issues with that with agents. The commission won't allow it, and they've had to either incorporate a new corp or change the name of the existing corp if they want to keep it. So it's not quite as simple as, letting Aaron and I know that it would be Aaron that you would let know if you're going to switch your commission income out of your corp back to personal. But you also have to let the NSREC know, and it's a separate licensing fee. So you pay salesperson licensing fee and corp licensing fee both. And then when you're removing it, then you have to cancel that separate license. So there's a couple extra steps in there.
Right. Not too bad. I was thinking in the higher cost of adding, I suspected, because we're like this with accountants too, I have to pay a separate fee for my corporation. Even though I don't provide services through my own corp, I provide it through Wild Timmins Michaud.
Yeah.
I have my own corp. It has to be registered with the CPA Nova Scotia, and I pay a $75 fee every year for no reason. Uh, Thanks,
Very
CPA
much
Nova
the
Scotia.
same.
So I'm not surprised that there's a bit of a cash grab there by the real estate board for that. I was thinking of putting it in my slide, but I wasn't 100% sure. But I was guessing that that was probably the case. So just an added wrinkle of costs.
Yep.
Uh, I put joint stock here. I don't think there's a major difference in joint stock between somebody that wants to register a business as a self-employed versus an incorporated business. And it's probably just slightly more every year. The corporate one's just $118 a year that you have to pay. So it's not a huge additional cost, but I just put it there as something that you do have to think about. It's an annual cost that you have, and there's filings to be had for corporate. Some people leave that with the lawyer, and then you have some more legal costs every year. Technically, you're supposed to document meetings, and when you declare a dividend, you're supposed to have that as a resolution in your minute book for the corporation. I rarely see that actually done on an annual basis or ever. So not that I've seen that discussed like when you do Google search for it, they'll add it as an admin kind of cost of keeping the corporation going. But I don't think that it's really a cost. Having a spouse. Okay. Years ago, and I go back to 2018, we used to be able to split income out of a corporation to whoever we wanted to. We could give it to our kids that were adults. We could give it to our spouse. So it wasn't uncommon that when our kids were going to university, we give them dividends out of our corporation, and we pay for their university. They would take the dividend income on their personal tax return. They wouldn't pay any tax on that amount. You could sprinkle dividends all over the place, and you'd wind up with huge tax savings. Really, and this is why I said 10 years ago, the answer was definitely yes. I could give it to my spouse who wasn't working, and it would save us a whole bunch of money on our personal taxes because I could divvy up that dividend amongst a bunch of different people. That isn't the case so much anymore. If you have a spouse that is not involved in your real estate business, you technically can't give them anything out of the corporation. There's a tax on split income rule that would make that dividend to them, if you were to give them a dividend, it would get taxed at the very highest tax rate. For dividends, that's 48%. So they would pay 48% on every dollar of that dividend if they weren't involved in the company. You have to look at what are called the Toshi rules, these tax on split income rules, to see whether or not you can get an exemption. I would say for a real estate agent, there will not be an exemption you would fall under to get your spouse who's not working in the business an exemption on money that you want to give them. So they would have to be involved somehow. And then you're running into whether or not you're paying them a reasonable amount for what they're getting paid, whether that's a wage or a dividend, same idea. And when we talk reasonable, we say, okay, what would I pay somebody that's not related to me for doing the same thing? That's what CRA thinks is reasonable. So if you would pay somebody down the street, $2,000 for doing that for the year, well, that's what you would pay your spouse for doing the same thing. So you're not looking at a huge tax savings there or splitting of income, it would have to be reasonable. Now, if they're 100, if you're 50-50 in it, uh, then you're splitting that income. But you can also do that on the personal side if you're truly both working the agency. Well, I'm assuming you would both have your own licenses and stuff like that. You'd just be reporting that income on your personal tax returns. You could do it as a partnership and split that 50-50 on your personal. It'd be the same thing as having in a corporate setting of which you're splitting that dividend out 50-50 to the two of you. So you're probably in the same boat as what we were talking about with the individual. So there's not too much of a benefit of the spouse anymore. And it can be really tricky paying them out of corporation. So it's something you have to really be careful about. Any other questions? The other con was the complexity. And we kind of went over this earlier. Sherry kind of mentioned this. In the corporate, you really need to keep that distinction about what's the company's and what's yours. Whereas when you're self-employed, you don't need to worry about that distinction. You can have all your money just go into your personal bank account and you use it. Nobody cares. All that they care about when you're self-employed is that income statement. How much money did you make? What are your expenses? Can you substantiate all those expenses?
And the only fly
For
in the ointment there is if you get audited, then they look at everything. All
Yeah,
up in your
it
business.
does get complex because and you run into the same thing. I recently went through an HST audit corporate, and they actually requested all the personal banking information for the sole shareholder of the company
No way.
because they wanted to see whether or not he was hiding income through his personal bank accounts that he wasn't reporting inside the corporation.
Oh my goodness.
So you can run into huge audits. It didn't result in anything, but when they start digging into stuff, you can get crazy results. Um, yeah, I mean, it might not be a bad thing to have a separate bank account, but if you're going to get audited, they're going to look at all your stuff because they're so paranoid about whether or not you're trying to hide something. And I mean, that is a little bit easier in respect to the fact that you're going to receive a slip from Keller Williams saying this is your gross earnings for the year. And if that's the only place you earn income, how can CRA refute that? And if you reported that all on your tax return, you got no problems. It's just whether or not all your expenses can be substantiated with all receipts. And they can get crazy with that. I mean, when they're looking like at your vehicle expenses, they'll look to see whether you have a log, and then they'll look to, okay, give me all your gas receipts. And then you're like, oh, okay, here you go. Here's my stack of gas receipts for the whole year. It can get crazy. Key in both respect, both corporately and personally, you got to keep everything, and you got to keep it for like 6 years. Um,
Oh, that's less than I thought. I thought it was 7.
sorry, 6 years from when you were assessed on that tax return. So basically, it works out to 7.
Oh, it does. Okay.
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 Because if you're self-employed, you're filing your like we're going to be filing our 25 here in April of 26. You'll be assessed May, June of 26, depending on when you file, because when you're self-employed, you really have till June 15th to file. So if you file June 15th and you're not assessed until July, well, then it's the 6 year clock starts at that point. And so it feels like 7 from the year that you're reporting on. So usually we say 7, 6, 7. They technically they say that your tax return actually becomes statute barred 3 years after it's filed. They would have to prove gross negligence to go uh, past that 3 year period. So usually when they're auditing you, they're looking at only one of the last 3 years. And so
Well, that's good to know.
this year we were dealing with some audits with respect to 2022 and some 2023. um, that were filed at that time. Anyway, um,
Would I be fair to say, though, that if you get audited and they find some abnormalities in the audit, can they then just go back and keep going back?
depends on how big it is.
Okay.
I mean, if they found you were missing a few gas receipts, they're not going to go back.
Okay.
Yeah, it usually revolves around if they feel that you misrepresented the income and you were hiding it, because then they're going to want to go back. But if you're missing a few receipts, um, like I've had the issue where the amount was on a Visa statement, but we didn't actually have the receipt. Well, it being on the Visa statement isn't, or on the bank statement isn't sufficient to justify the expense. You actually have to have the receipt.
Oh gosh, there are agents I need to talk to right after this meeting. There's so
Yeah,
many agents that I know right now. They're like, "Do you want the receipt?" And I'm like, you always want the receipt." They're like, "No, it's
yeah.
fine. It's
And
on my Visa." And I'm like, "No, it's not okay."
no, yeah,
So,
yeah.
thank you.
Unfortunately, like again, the HST audit that I just went to, unfortunately, the bookkeeper for the company booked things in lump sum.
No,
So
no.
she did one transaction to record the whole Visa statement for a month. Okay. I would not suggest that. Uh, I know it becomes a pain in the butt, but you really want, when you're accounting for your expenses, to account for things on an individual receipt basis. That way, when they do their test, they're only looking to test a specific receipt. If they're if you do it on a lump sum basis, like my client did, the test was, okay, support this journal entry for the whole, you know, July Visa statement. You know, in the case of my client, that was a $90,000 Visa statement, of which, of course, it became up to test because it was a large amount. CRA usually looks at large amounts and to test. And so if they had broken it all down, a lot of it was small amounts. I mean, yeah, there was a couple of items that were thousands of dollars each, of which we had the receipts for, but it also included, $50 gas bill and, oh, he went and bought a part, a supply for like $20 that they needed like right now to do the job. Well, we needed all those receipts. Well, guess what? Some of them we didn't have. So now, see, now we're giving CRA the ability to deny us expenses because we didn't have the receipts. And in this case, we were lucky that CRA kind of played ball with us a bit. They didn't hit us too badly. At the end of the day, the client was okay with the end result, but we did lose some amounts because we didn't have the receipts. Yeah, I I mean, if your accounting is difficult, I would suggest using some kind of package to do it. If TurboTax keeps all your receipts, that's great. Some people use QuickBooks if they're a little bit more complicated. Some people use Sage if it's a little bit more complicated. I use Excel in smaller cases, and I just itemize what's going on in the bank and on the Visa statements in Excel, and categorize it by the expense type in Excel. So that, again, another tool that can be used. And if CRA was to audit, I would just give them the Excel spreadsheet and I say, this is how I broke it all out. And they could pick and choose the individual items that they want to test.
How complicated is your spreadsheet? Like, just just
Uh,
asking because I happen to love spreadsheets. I'm just wondering, like,
so what
how
I
hard is that
do,
to do?
the, I mainly track the spreadsheets I do are usually geared towards corporations.
Okay.
So the key in the corporation is the bank account. We need to make sure that the bank account's right at the end of the day. So my spreadsheet really revolves around tracking every transaction that goes through the bank account. Okay, so I have the date, I have a description, I have the deposit or withdrawal from the bank, I track the bank balance, and then what I do is I take that amount that's being deposited or paid out of the bank, and I break it out to what it's for. Okay. Easy for the deposits. That's usually all just revenue. It's the amounts going out that are a little bit more complicated. And I do the same with the Visa. So that would be like, okay, is it advertising? Is it my vehicle expense? Is it my gas? Is it maintenance on the vehicle? Is it the insurance on the vehicle? Um, there's a whole bunch of, is it my telephone bill? I'm trying to think of all the expenses you might have on your tax returns off the top of my head. So whatever categories you have, is it the fee I paid to Keller Williams for taking care of this stuff? So there's a bunch of different categories you might have. I would have columns for each of those. And so whatever I paid for, I break it into those columns. As long as they total up the same, then I'm good. Uh, and I I usually try to get the client to do their first go at it, and then I kind of tweak it myself and I give it back to them. And I say, this is how I really like it. Uh, uh, your first go around was pretty good, but here's a little better. Um, but yeah, I've done quite a few in Excel. Once you start getting a little bit more complicated and a little bigger, probably better to start thinking about an accounting software package. If you're incorporated, even more so than self-employed. Uh, if you're self-employed, I would think the Excel spreadsheet might be a really good way to go to summarize your stuff, even if you have an accountant. If somebody gives me a summarized information to do their personal tax, that really drops their personal tax bill down because I don't have to do the work. They've done it for me. So that makes the difference between the corporate and the personal even more because the personal is now a lot cheaper. So any way to keep that track of that information needs to be done in both situations. It just could be a lot more complicated in the corporate setting than the personal. But for the most part, they'd be about the same.
Okay.
I kind of lost track of where I was. The other complexity, we were talking about closing the company down. In the case, I didn't think it was too difficult. The complexity can be added on death. You die, you got a corporation. That's just something more that the person that is your executor has to deal with. Uh, you have to think about adding that to your will and what's gonna happen with this company after you die. Um, if you've been keeping money in that company, you definitely have something that needs to be dealt with after that point in time. So that has to be dealt with. There could be probate issues with respect to having a corporation when you die. So you have to be aware of what that possibly could be. So it just adds some complexity to that decision on whether to incorporate it or not. And then I think that brings, other factors. Uh, COVID brought this up. I would have never thought that this would have been an issue until COVID hit. When COVID hit, most of the government assistance programs revolved around having wages, whether or not you were paying employees or whether or not you were earning a wage yourself. Now, they included self-employed income in that as a wage. So if you are incorporated, let's say as a sole shareholder, because you're the only one running your agency, and you're paying yourself dividends, well, guess what? The government wasn't helping you 1 cent during COVID. And so now you had to figure out how you were going to survive not having a job, because as a real estate agent, I'm assuming you weren't running around selling houses too much during COVID. What you were going to do when there was no money coming in. Now, if you save some money in the company, yeah, you're probably pulling some of that out to live on during that time. But again, the government wasn't helping you out. If you had earned this personally, you probably had a little bit of assistance, probably not a whole lot, but you had a little bit uh, with respect to that. So, and the way they did it is if you were incorporated, they said, okay, if you have wages, we can help you out. Well, if you were the owner, you couldn't all of a sudden pay yourself wages. because they said you had to have been paying wages the year before COVID hit. So you had to know that we were going to do this program a year before we actually did the program for you to benefit for having wages inside your company. So just an added wrinkle of, if something like this was to happen in the future, don't expect CRA or the government to help you out if you're incorporated, because they didn't help out a lot of our clients during COVID.
There was
So
a
that brings
note
me to my
here.
conclusion.
Yeah, so Travis Mesher has a question. Said, if
Oh,
you have mileage log, do you still need to keep gas receipts? I
oh
think I
yeah,
know the
definitely.
answer to that.
Yeah,
Go.
unfortunately. So the mileage log, all that supports is the ratio between your business and total kilometers. And if you don't have that, if you're incorporated and you have vehicle expenses and you don't have a logbook, they're going to deny all your vehicle expenses. If you're self-employed and you don't have a logbook, they will deny all your vehicle expenses. So that's what the logbooks gives you. It gives you the starting point where CRA says, oh, you have a logbook? Okay, now we'll look at whether or not we're going to allow your vehicle expenses. And it sets the ratio of what you're allowed to deduct. In a corporate setting, we usually say, hey, it's all used for the thing. And they say, well, prove it. Give me a log showing that all your vehicle is used for business purposes. And so you still need the logbook in the corporate setting, and you still need all your receipts. Because once the logbook says, oh, it's like 90% that I can deduct, you still need all your receipts to support the expense that you're going to deduct at 90%. So yes, you need all your receipts. I know it sucks, but that's the case.
Side note, if you're using I guess, a book with a pencil, you might want to upgrade it to Mile IQ. And then you get to choose whether something's a business or a personal expense, and you can log details in there, and it's a little bit easier, and it tracks it whether you've said, oh gosh, I forgot, I went and did this. It automatically tracks for you. So,
The
so
other thing is you don't necessarily have to keep the paper receipts. If you scan everything, they will accept the scanned copies. So that's fine too. Uh, what details you? Um, for logbooks, all I have is so you're dealing with it on your self-employed side, you're dealing with it on a calendar year. Corporations don't necessarily have to be calendar year. So you want to have your opening odometer at the beginning of the year and your closing odometer, and then all you really need to track in your logbook is your actual business use. So if you've gone to so and so of a client, if you've done so many runs, you just detail what you've done and how many kilometers it took you to do it. I would say you would even be okay if you're doing a big loop, like you went and looked at showed a whole bunch of houses, showing houses with so and so client, you know, 64 kilometers or 120 kilometers or however many kilometers you did on that loop in that day. That would be fine. They're actually pretty reasonable if you just attempt to put something together to show how you used your vehicle. So you need kind of some description of what you're doing and then just the business kilometers. And as long as those total business kilometers agree with what you're stating on your tax return, you're good. I've reproduced logs after the fact. So when CRA comes in and is actually doing their audit and they say, hey, where's your log? And I'm going, shoot, we don't have one. I reproduced one with the client at that point in time. We put in a whole bunch of information and we tidied it up and we've given it to CRA and they've accepted it. You don't necessarily have to have the log at that time. Would be a lot easier if you do, because if you're thinking about afterwards, you're going, okay, where the heck did I go? Like even last week, where did I go last week? I went to all these places. If you're thinking about it, they're usually doing these audits 3 years later, and you're trying to reproduce what your log was 3 years ago. Good luck trying to figure that out at this point in time. So really key to do it right now. But yeah, I just would have what your business kilometers are, and as long as you know what your total kilometers are because you wrote them down, January 1st, my odometer said this, and on December 31st, it says this. That's my total kilometers for the year. My log tells me my business, that tells me my ratio. Pretty easy. Anything else? So my conclusion is that there appears to be a slight advantage to incorporating. Again, I would say this could be at various levels. And it seems to be even if you're pushing all the money out. Um, Again, when I did this quite a few years ago, the difference was quite smaller. So it really is contingent about where we are with taxes at any given point in time. And unfortunately, the government could come in and change that in their next budget, and my answer could be different in about 4 months from now. When their budget comes out in March, the federal government, they could, and being the Liberals, they haven't been too friendly to corporations over the last 7 years because they're the ones that introduced that tax on split income that really destroyed the splitting of income out of a corporation and really would have made my answer a lot easier if you were asking me 8 years ago. We always anticipate that when the Liberals come out with their budget, there's going to be something in there that's not good for companies. Um, and an example of that is their discussion about how they were going to treat capital gains. And they were going to tax capital gains differently in a company versus personally, which is quite odd and really goes against the whole integration concept that we have with taxes. But that's just the Liberals for you. We need to find some money to cover our deficit, and so we're going to get it from the companies instead of anywhere else. That's their first thought process. If the Conservatives got in, their thinking is a little different. But given the current regime with Trump down in the States, I don't think the Conservatives are going to win here in Canada in the foreseeable future. So we're stuck with the Liberals for now. And they seem to be doing okay. I'll just say okay. They decide not to introduce the capital gains difference at the end of the day. I think a lot of people were confused about that. They didn't realize that it was going to actually affect them pretty big at some point in time in their lives. Because if you have, like, say, a cottage, you'd pay a lot more tax on that when you sell it than you would under the current regime of capital gains tax. But anyway, that's just the way it is. That's what we live in as accountants, continually changing tax system, and we just have to deal with what they give us at any given point in time.
Okay, very good. Well,
Anything
Henry,
else?
really
I
want
guess we're
to.
kind of slightly over, so that kind of worked
That's
out nicely.
okay. Yeah, it did. There you go. You're like it's going faster than you thought, and then suddenly the time was gone.
Yeah.
So,
Well, and I anticipated the questions were going to be a bulk of the time, so that's good. I'm
well, there you go.
happy to answer any questions
That's
people had.
great. Excellent. So does anybody have any other questions for Henry before we let him go? And just as a little plug, he mentioned this before, but he is with Wild Timmons Michaud Inc. So if you don't have a tax accountant yet, please consider Henry Michaud as someone to have in your corner to deal with all these fun pieces of having a business. And on behalf of the Profitability Committee, I'd really like to thank you for making this time before literally the busiest time of year for you. So I know there's no chance of talking to you in the new year, but
Yep.
we
No.
so appreciate your time right now, just under the wire, just before Christmas. Gets
Yep.
everybody's minds thinking about the way they should be looking at their business for next year and how they're actually doing
Definitely.
things and whether or not incorporation is right for them right now. Maybe it's going to be right later, or maybe it's never the right decision. Thank
Yeah.
you so much for breaking that
Yeah.
down.
The nice thing is that it's not a decision that needs to happen right now. It can happen at any point in time. Uh, Question is whether or not we run into more complexities with your business down the road. As an agent, I don't think we run into that, like I mentioned earlier. Uh, that as an agent, really the business is related to you. And so you moving that business into the company, I think it'd be pretty clean to do it. There's not a lot of things. I mean, you are running into the issue of, if you have employees, then you're changing payroll, you're getting a new payroll number, you're having to make that change. That may be something you'd want to do around a new year instead of in the middle of the year, because now you're shutting off one payroll account in the middle of the year and starting a new one. Again, if you're registered for HST, you have to register for HST for the corporation. It's a separate entity. It has a different number. You can't use the same number going forward. And so there's that kind of administrative stuff that needs to be dealt with if you're incorporating. So it just adds a little bit more complexity initially to get going.
I
But
also would
after,
imagine seasonality of a realtor's business would have an impact as well, because there's seems like a huge cost coming into it. You'd have to have that cash to outlay, I would imagine, plus anything else you're not considering. So, like our biggest market is typically spring, next biggest is fall. So, trying to understand where that timing should land in terms of incorporation could be very important as well.
well, probably more so with when you want to consider the year end of the corporation.
Oh, okay.
Corporations can have any year end. They could technically have a year end, December the 10th. Um,
Okay.
they don't necessarily have to do a calendar. We usually, I think 99% of our clients have a year end that is at the end of a month. I have year ends January, February. I have year ends for every month. Um,
Okay.
we actually do have a client that has a year end that's in the middle of a month. I don't know why they have that. They ended up having that, but and they've stuck with it. That's a complex one for us to keep track of. Doesn't fall nicely with how we deal with our deadlines. But if you find that you're really busy, in the spring and the fall, then having a summer year end, like May, June, wouldn't may not be too bad, because then it gives you the time to prepare your information for your accountant in at that timeline, and then for them to work on it, and have it done hopefully before you're too busy to meet with them to to sign off on this stuff. So there's that consideration. Some people just like having the December year end because then it ties in with their personal taxes, the reporting, both corporately and personally, but it doesn't necessarily have to happen that way. There is some benefits when you incorporate and have a different year end. You can play some games with how you report that income personally between years sometimes. So there's some games we play there, where we can defer some taxes between two different years if we want to. I don't usually get into those games too often because at the end of the day, it could bite you in the ass. Because
Fair.
if you say, hey, let's defer some to next year, and then next year you pull even more out, then all of a sudden your taxes for the next year is even higher than what we were planning. So, but there is some things like that you can do in a corporate setting. You have no choices like that on personal taxes. Personal taxes, you're paying tax on the income as you earn it. Corporately, there's a few things we can do with respect to the income as you earn it, not as the company. The corporation still pays tax on the income it earned in the year it earned it. So it can't defer it, but the tax rate is so much less than on the personal side. So when we look at the corporate setting, it's always how do we defer the tax on the personal side from you reporting that income on your personal tax return? And is there ways that we can get around that or reduce it on the personal side? So,
Excellent. All
okay,
right. Thank you so much,
no problem.
Henry. Thank you everyone for coming. I saw a couple of people had to jump off at the end there, but
Yeah,
the session is going to be recorded, so they're going to catch that when they listen back over it again. So thank you so much for your time. Really, really appreciate it. And thanks to everybody who came today. Love to see the interest in your business and how you want to move forward going into 2026. The more information we have about how to successfully run our real estate careers as businesses, the better off we all will be. So thank you very much.
you're welcome. Thank you for having me.
No problem. Take care.
Thanks,
Bye.
Henry.
Thanks, Melissa.